Hello everyone, this is Craig Larson from Larson Financial Advisors for our market message on May 2nd, 2013. Thanks for joining me, and today I'm going to talk first of all an update on gold. When we did the video a couple of weeks ago, gold was in the middle of a pretty rapid decline. And so if we go back in history a couple of years, you'll find in gold that the price point at $1,550 an ounce has been an important level. When gold first got up to that level, it had trouble breaking out, and after it broke up above $1,550 an ounce, it went back down and found positive support there and was able to rebound up from that level 5, 6, 7 times over the last couple of years. So 2 weeks ago, I think a lot of people following charts were expecting gold to find support at $1,550. It didn't. It just sliced right through, went all the way down to $1,350 an ounce briefly, and it's rebounded a bit to about $1,457 an ounce as of today. So I think what we want to do is watch that line. Gold will more than likely try to challenge $1,550 an ounce. Statistically speaking, it's probably not going to break back through. If it does break back through, we may still be intact on the bull market in gold. I think it'll probably get repelled and go back down, which means gold has some more downside work to do, and we'll just have to watch it. Secondly, no major shifts in broad asset classes. U.S. stocks still are the best trending, strongest group of the year so far. International is in second place. Not seeing a lot of good positive performance necessarily in international. Bonds are in third place. Commodities are still down in sixth place. So besides the breakdown in gold a couple of weeks ago, we've recently seen breakdowns in copper on the chart and oil on the chart. So that's an indication that there's not a real strong global economy right now. All right, then let's go to the U.S. market. The trends and relative strength we see in U.S. stocks is very strong. We haven't seen any major reversals yet. One of my risk indicators, called the New York Stock Exchange Bullish percent, has reversed down. So all that means is that the number of stocks participating in new market highs is starting to wane. So the S&P 500, it's set an all-time record high. The Dow is close to all-time record highs. But we're having less and less stocks participating, and that's pretty typical of what happens near the end of a very strong market rally. You have to start getting more and more choosy about what you own. And then secondly, we've got the sell in May and go away market adage. And all that means is when you look at stock market history, the strong half of the year seems to be November 1st through April. The weak half of the year seems to be May 1st through October 31st. And when you look at the data on the Dow Jones in particular for the last 60 years, we found that the strong half of the year accounted for over 7% average annual return, and the weak part of the year was actually slightly negative about 0.5% per year on average. So this is by no means a reason to run away and sell everything, but I think you want to be cognizant that now we're heading into the seasonally weak time. Will it be a good year for sell in May and go away? We won't know. Maybe it is, maybe it isn't. But it is a good excuse between selling in May and the bullish percent reversing to just do some spring cleaning in the portfolio. So what I'll be doing internally with client portfolios, and what you might want to do in your own, is look at how things have been and sell your laggards or your weak holdings and hold on to the good ones. And in that way, you'll raise up some cash to be ready for the next good buying opportunity. With markets, really amped up over the last 4 months, well above their 200-day moving averages, it's not the best, most opportune time to plow a bunch of money in. So be cautious on things. More than likely, we'll see a pullback in markets, maybe all the way back down to the 200-day average, and that'll be a much better time to get in. That would be about an 8 to 10% drop from here, and it just takes a little patience. It may take a month, 2, 3, 4 months to get there, but raise a little cash and be ready to go on the next round, and I'll keep you appraised of what the opportunities are as we see them here. So thanks for tuning in, and have a great week.